So right now, the stock market is suffering from this massive split personality.
Oh, absolutely. It's totally disconnected.
Right. I mean, you've got the tech-heavy indices basically bleeding out from this intense semiconductor sell-off. But then the Dow Jones is sitting there, closing recently at like 51,666, just completely shrugging off the panic.
Yeah, it's holding the line remarkably well.
It really is. It's acting like this sturdy brick house right now, while the rest of the market, especially tech, is going through a massive power outage. So today we are doing a deep dive into why the Dow is practically bulletproof at the moment, and whether a massive new tech giant entering its ranks is going to reinforce that strength or just, shatter the glass.
That structural split is exactly where we need to focus your attention today, because we're so used to these indices moving in tandem, But right now, capital is actively using the Dow as a safe haven from all that tech volatility.
Which is pretty ironic, right? Because the Dow is about to get a huge injection of tech itself.
Massively ironic. Alphabet is officially joining the index next week, which is, it's huge news.
And that fundamentally changes the DNA of the Dow, because we're talking about a purely price-weighted index absorbing one of the biggest market cap companies on Earth. How does that actually shift the mechanics?
It completely alters the math. Because the Dow is price-weighted, a highly priced stock commands way more influence over the daily movement, regardless of the company's total overall value.
Oh, right. So it's not like the S&P at all.
Exactly. So injecting Alphabet creates this immediate structural volatility. Institutional funds are mechanically forced to rebalance their portfolios just to mirror the new Dow composition. And you got to layer this rebalancing on top of Micron Technology's upcoming earnings.
Oh, wow. Yeah, because semiconductor sentiment is basically steering the whole broader market right now.
Right. Any earnings miss from Micron could aggressively drag tech down even further.
So we have a structural index rebalancing colliding with a really sensitive tech earnings report. And, if that isn't enough friction, we also have Thursday's US GDP and jobless claims, plus Friday's core PCE inflation data.
Which is the Fed's favorite inflation gauge, by the way.
Exactly. And we know traders are hyper-focused on interest rates. So if that inflation data comes in hot, how does that alter the playing field for Alphabet's big entrance?
It acts as a massive accelerant. If the data suggests inflation is sticky, the market instantly prices in higher interest rates for a longer duration.
Which nobody wants right now.
Nobody. So when you combine that macro anxiety with the mechanical portfolio reshuffling required for Alphabet, you get the absolute perfect conditions for severe, unpredictable price swings.
Okay, so you're laying out a pretty precarious fundamental picture here. But, if we look at the actual price action, the Dow seems completely unbothered.
It really does.
Yeah, it's maintaining an ascending channel. It's making higher highs. The monthly chart goes all the way back to that March 2020 crash at the 18,000 zone. And right now the daily is holding steady above 49,000. Institutional buyers are clearly defending it. They are. And on the surface, the long-term reality looks remarkably bullish. The underlying structure from the monthly chart all the way down to the daily is absolutely intact.
Wait, I have to challenge you on this idea that it's remarkably bullish, because honestly, that feels like a mirage.
How so?
Well, if you look at the Relative Strength Index, the RSI, across every single one of those timeframes, monthly, weekly, daily, there is a glaring bearish divergence. The price is going up, sure, but the momentum behind those moves is visibly dying. It's kind of like a marathon runner, right? They look completely fine on the outside, putting one foot in front of the other, but secretly they're completely running out of oxygen.
That's a perfect analogy. It's not a mirage, but you're accurately spotting the tension there. The runner is exhausted, right? The price is making higher highs, but the stride is losing all its power.
Exactly. That RSI divergence is the structural warning sign that the prevailing trend is exhausting itself.
Okay, so if the runner is running out of oxygen, where exactly is the finish line? Or, the point where they finally collapse?
The immediate battleground is on the 4-hour chart. We have a crucial demand zone sitting right at 51,450.
And the demand zone is just where buyers have historically stepped in, right?
Right. It's a specific price level where a massive influx of buy orders has overwhelmed the sellers in the past. If the price breaks and closes below 51,450, that tells us the buyers have finally retreated.
So the runner stumbles.
The runner stumbles, and we are likely heading down toward 50,500.
And the upside, what happens if they hold that line?
If buyers defend 51,450 and push the price into a strong breakout above 52,000, that opens the door to retesting all-time highs. It essentially means the market found a second wind.
Which leaves you with a really fascinating dynamic to watch unfold this week. Because you have to wonder, is Alphabet's structural entry into the Dow going to act as the fresh oxygen this market desperately needs to push past 52,000?
That's the million-dollar question.
Or is this major fundamental shift going to be the exact catalyst that triggers the deeper correction those RSI charts have been secretly warning us about? I guess we'll see soon enough.
We definitely will.
If you found this market analysis helpful, make sure to like the video and subscribe to the Investor's Edge YouTube channel for future updates. Keep a close eye on those charts.